Hey, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and the equity markets are in a much more concerning state than when we convened last Tuesday. Last Tuesday, we talked about the fact that the markets were on the precipice of what could be a significant pullback here. And what we've seen since then is the S&P 500 and the other major equity indices have all broken below major support levels. If you look at the 5,800 on the S&P 500, that was previous support that had held. This was also the November 6th election breakout level here. So important level that the market tested last week when we convened. Now we are decidedly below that level on the back of tariff uncertainty and concerns around overall recession here in the U.S. economy. That fear has kind of driven the S&P 500 below these major support levels. The next support level is really coming in around 5450, 5400 here to the downside on the S&P 500. That's our next downside target here. So things looking a lot weaker than when we met last week. $500 level on the Qs was also decidedly broken here. The next level of support on the Qs coming in around 445. So still a fair amount of downside to go in order to hit those downside targets. You have IWM equal weight S&P 500 index off to a fairly weak start here. The IWM is much closer to prior support here around 197, 200 or so. And equal weight S&P 500 is the only index that did not break below prior support here around 175 or so. Across the board, the market cap indices underperforming the equal weight S&P 500. But the fact that the equal weight S&P 500 showing a fair amount of outperformance is um, a net positive here for the markets, meaning there's less of a concern of a much bigger um, sell-off here across the board. So we'll continue to monitor this over the next week or so and continue to update you on where we are. But value has continued to outperform growth by a pretty wide margin here since in 2025. You have commodities continuing to trade to the downside here with gold and oil both trading. I mean, gold pulling back a little bit, but oil trading at 52-week lows, at risk of potentially making a new 52-week low. You do have bonds also pulling back a little bit here. This is specifically the high yield corporate bonds selling off a little bit here, showing that there's a little bit more of a risk off environment that the bond markets, from a credit perspective, is starting to price in, even though overall we've seen a pretty strong rally here in oil in bonds as a result of flight to safety and the interest rates that have declined as a result of it. But as you can see, the VIX closing yesterday around just shy of 28%. That's basically in the 99th percentile over the past year with regards to implied volatility on the S&P 500. This certainly favors option sellers at the moment from a relative perspective. The fact that we're in the 99th percentile in terms of implied volatility compared to the last year um, gives opportunities for strategies such as selling cash secured puts, credit spreads, and even iron condors to take a bit more of a neutral view here after what has been a fairly significant sell-off here for equities. We've seen stabilization a little bit across the board here, and especially of interest rates as well, covering around that 4.2% level on the 10-year yield. And as you can see, bonds rallying off of these $84 lows on TLT, and continuing kind of to that this kind of zigzag structure, but higher highs and higher lows, suggesting that the flight to safety continues pressuring interest rates lower. And just to mention, what's interesting is the fact that the bond markets now are pricing in 3 rate cuts for 2025. Compare that to just a month ago when we were expecting only 1 rate cut for 2025. Really speaks to the pretty sizable shift in terms of um, expectations for Fed policy in 2025. That's the bond market pricing in a much weaker economic growth. And as a result of that weaker economic growth, expecting the Federal Reserve to cut interest rates multiple times in 2025 as a result of that. So that's probably been the largest shift in terms of sentiment over the past 4 weeks or so from investors is really their expectations for growth in 2025. We've seen consumer brands continue to sour on their outlook for 2025. We saw a big change in Delta's outlook here overnight that caused the stock to be, down a pretty significant amount pre-market here. And that really all is tied to expectations of consumer spending starting to deteriorate in terms of expectations for 2025. So any type of consumer brand, especially stocks like Apple, I think are significantly at risk, especially stocks that are consumer brands rather that are trading at relatively high multiples are the ones that are probably at risk the most of some further downside. So we'll talk about some of those here in a second. You have the dollar index selling off substantially here as a result of the lower interest rates. Bitcoin selling off here as well, around 81,000. After we tested 80,000 a couple of weeks ago, traded all the way up to just shy of that 50-day moving average, and now trading lower here, suggesting that there could be further downside here for Bitcoin. And gold, as you can see, also after breaking out to new all-time highs, failing to kind of make a new high and at risk of starting to roll over here again. With oil, as you can see, testing new 52-week lows at $66. The 52-week low is somewhere around 65 or so. So we'll continue to monitor that because we could see some further downside here in terms of oil. And then if you look at the sector rotation, this is really, if you look at the rotation, we've seen a clear shift to the more defensive sectors. Consumer discretionary and technology, as you can see, major underperformer here in 2025 over the past few weeks since the beginning of the year. The cyclical sectors of consumer discretionary and technology underperforming the S&P 500. On the flip side, communications continues to outperform. It's continued to outperform since September by a pretty wide margin. You see the same thing here in terms of financials. So financials still showing a little bit of outperformance here, but note the significant move we've seen relative to the S&P 500 in consumer staples. And the fact that consumer staples, as you can see, on an absolute basis is actually, pretty much near 52-week highs, and actually just in the last few days continue to make new 52-week highs, really speaks to the overall strength of the US economy. We're not seeing the sell-off across all sectors. We're seeing sectors sell-offs in more of the cyclical sectors. The fact that that flow is then flowing into more defensive sectors is a sign of sector rotation. It's a sign of what you typically see during a consolidation phase. So while this consolidation phase certainly feels a lot different than prior consolidation phases, and there's certainly been big violent moves to the downside, at the moment when we look at that sector rotation, it is still constructive here for the equity markets, and arguably as healthy for the equity markets to see this level of consolidation after what has been a multi-year, and you could even say, nearly approaching 2-decade bull market here. To see consolidation is not particularly a bad thing, which, in other words, there could be some buying opportunities ahead, especially if volatility kind of spikes towards that 28% level on the VIX. You see that defensiveness of healthcare outperforming the S&P 500. You see materials outperforming the S&P 500. You see industrials outperforming the S&P 500, and even real estate, on the back of what are lower interest rates, performing for real estate, utilities, a lot of these sectors, as you can see, haven't sold off. They're really just trading sideways here. So the fact that you've seen technology and discretionary sell off so heavily, and that flowing into these other sectors, leads me to believe at the moment there isn't kind of this widespread panic that would suggest that you have significantly further downside that would warrant, shifting your long-term investments, thinking about hedging your portfolio. But this is definitely a time to be a lot more cautious of that, and aware of these major levels, and if they were to break, kind of what the downside targets are, because those downside targets provide potential buying opportunities. Um, and actually, probably most importantly, semis continues to underperform the S&P 500 by a very wide margin here, trading basically at 52-week lows. So what has been one of the primary drivers of growth in this particular market, especially from technology companies, have continued to underperform, and that's part of what's driving, the weakness that we're currently seeing here in the U.S. equity markets. So with that, what I want to turn to right now is looking at some of the ideas for the week. I think given the current market conditions, there are a few to take a look at. So let's take a look at kind of some opportunities here. I do want to take a look at some buying opportunities here. So first one I want to take a look at here is Adobe. And the opportunities that we want to take a look at here largely, have a combination of technicals and fundamentals here. Adobe, we've liked Adobe multiple times throughout the year. And if you look at kind of a longer term chart here for Adobe, if we look at actually a weekly chart here of Adobe, you see that the stock has kind of it's been a bit of a downtrend here over the past couple of years or so. But largely has been sort of range bound to some degree between, call it 400 and 600 or so. And right now we're trading near the bottom end of the range. And that's really kind of what provides a potential buying opportunity for stocks like Adobe. If you look at the stock here, it's been in a multi-month downtrend here, but what looks like starting to be a bit of a bottoming formation here. We're looking for a bounce higher here. And but I think the most attractive thing about Adobe is really the valuation. It trades at 22 times forward earnings. Given kind of growth expectations that are roughly in line with what Apple's expecting, we're looking at EPS growth that's in the 12% range, revenue growth in the 9-10% range, which is actually a little bit higher than Apple. And net margins are in the 25-26% range, which is also just slightly ahead of Apple. For a business like this that's focused on AI, that's primarily reoccurring subscription type businesses, trading at only 22 times earnings, even though it has growth and profitability metrics that actually exceed Apple, is quite inexpensive from a valuation perspective, especially if you put into context, Apple's growth expectations and profitability metrics are slightly below Adobe's, yet it trades at 32 times forward earnings. So Adobe here actually represents, a nearly 30% discount to Apple, if you consider kind of how fast the businesses are growing and how profitable they are. So Adobe, in my opinion, in this type of market condition, provides the upside opportunity with downside or lower downside risk because of the much lower valuation that it currently trades at, and a very attractive valuation that it currently trades at. The next stock I want to take a look at here is some of the Chinese stocks. Last week we talked about Alibaba here. Since we talked about it last week, this stock has continued to trade to the upside here. It's recently pulled back a little bit to that 130 level, and that actually provides a really nice potential entry for further upside. Alibaba trading at about 13 times forward earnings, which compared to the industry average around 22, 23, represents a similar, roughly 50% discount to the industry. Growth expectations for Baba are largely in line with industry expectations. So the fact that it kind of is actually slightly beating industry expectations in terms of growth and profitability, yet it trades at a 50% discount, represents the fairly significant upside potential here for Alibaba, especially as the Chinese government kind of has been on a deregulatory push for the Chinese tech companies. We've seen Jack Ma back in the public eye, something that we haven't seen in multiple years. Really speaks to some of the confidence that we're seeing from these types of companies, and represents, a very attractive valuation to take to gain exposure to the AI space through these Chinese tech companies versus a lot of the US tech companies that are focused on AI are trading at very, very lofty valuations and harder to justify as an investment. If you look at stocks like PDD, this is something that was covered last week here as well. PBB trades at 9 times forward earnings. We're expecting EPS and revenue growth that's north of 30%. I think it'd be pretty hard to name a single US retailer expecting to grow top and bottom line by 30%, not to mention net margins that are just shy of 30%. The industry average in terms of net margins is around 10%. So the fact that PDD is nearly triple that and is growing significantly faster than the industry, yet it trades at about 9.5 times forward earnings, represents a significant discount that it trades at. This is a stock that trades at more than 50% discount, it's trading closer to about 60% discount to its peers, especially, and that's not even factoring into the growth expectations and profitability metrics that are significantly superior to the industry. So for those reasons, PDD actually represents, in my opinion, out of the Chinese stocks, one of the biggest upside potentials. And the reason that I think that it's trading at such low valuations in the moment is partially, risk with regards to, slowing consumer trends, but also the trade war. The trade war between U.S. and China squarely puts stocks like PDD sort of in the center of it, and I think investors are concerned about it, and that's why it trades at these kind of bottom bargain valuations. But because they are at bottom bargain valuations, from my perspective, the downside risks are lower, versus the upside potential here is fairly significant, especially if the U.S.-China trade war starts to ease or starts to see resolutions towards an agreement that is perhaps better suited than slapping tariffs on each other. Um, One stock to continue to look at here that we've talked about here in previous weeks is CME. They operate the world's largest futures exchange, one of the few stocks that continue just to move upwards and to the right. This is largely because net margins are north of 55%. We're talking about net margins that are in the same realm as Visa and Nvidia. Very few, and Costco. Very few stocks have, net margins in that north of 50% range, but CME is one of those. And in this type of market environment where there's concerns around the strength of the US economy, stocks like CME that virtually print money for every dollar they generate in terms of revenue. are kind of the safety plays that investors are seeking in this type of market environment, and CME a net beneficiary of that. And I think worth taking a look at. I'll just mention Visa because Visa, very similar to CME, has net margins north of 55%, but obviously far more exposed to consumer trends. I do see some downside risks into the 320 range, but that's really kind of where I see the potential buying opportunity here for Visa. Um, Another tech name that I really like here right now is Meta. Meta has pulled back to a major support level around 580, and I think that's really a bounce potential level. Trading at only 24 times forward earnings. Given the growth expectations that are in the 12-13% range for both top and bottom line, and net margins that are exceeding 35%, the fact that it's trading at only 24, 25 times forward earnings is just downright inexpensive. Again, especially compared to stocks like Apple, where you have very similar growth rates, profitability metrics that are slightly lower than Meta, yet it trades at 33 times forward earnings, but Meta trades at 24. So I think the upside potential here for Meta is so the upside versus the risks in Apple is to the downside. And we'll take a look at Apple here in just 1 minute. Um, Amgen continues to be a star performer here in the healthcare space. As you can see, recently testing new 52-week highs at the 335 level here. We'll see if we can break out here, but a breakout here would be a very significant double top here. If you look at a weekly chart here for Amgen, this is a multi-year double top. You can even consider calling that a triple top. That would be a significant bullish signal here for Amgen, trading at about 15 times forward earnings. It doesn't grow very fast. These kind of pharmaceutical companies generally don't, but it is just as profitable as its industry. And it's trading currently at a premium relative to its industry. But that's really where I think the valuation is justified given the growth expectations that we have here for Amgen. I do think NVIDIA is continued worth uh, paying attention to here, right? We've pulled back here NVIDIA to what is some major support levels here around 105 or so. You can draw your lines a few different ways, but as whether you approach it as a 105 or 100, these are both levels that I think are worth paying attention to here right now. Uh, because NVIDIA is now trading at 25 times forward earnings. Um, Look at growth expectations. We're looking at top and bottom line growth of expected around 30%. So similar to PDD in terms of growth expectations, net margins north of 55%. Really, there are no stocks in the S&P 500 that's expecting to grow top and bottom line at this pace and is as profitable as NVIDIA. So the fact that it trades at 25 times forward earnings is downright inexpensive and makes the investment opportunity for the long run fairly attractive, in my opinion, and represents what I believe is one of the best value opportunities in the US equity markets here right now. Vice versa, compared that to Apple, like I said, Apple trades at 30, 32, 33 times forward earnings. And recently, as you can see, both times it kind of rallied off of this call it 220 into that 240, 245 range. The stock has been rejected. It's been rejected. My concern is that if you look at kind of consumer trends, the stock is still continuing to hold out, and investors are still continuing to hope that, Apple as manufacturers of iPhones are immune to some degree to the slowdown in consumer spending. But it's very clear over the past few months, the tone that has shifted with regards to Apple's outlook expectations. And I simply think that there's further disappointment ahead for Apple investors. And I think that's really where the downside risks are substantial. especially if you consider that growth expectations have come down substantially. Even though net margins have been stable, the downside risks are significant when you consider the fact that consumer spending is clearly slowing down within the spaces that Apple is trying to innovate for their future. They are very much, in many ways, lagging behind in two of the primary areas of the future. One is augmented reality. We see companies like Meta and Snapchat clearly are in the lead compared to Apple in that particular space. And if you look at artificial intelligence, Meta, Microsoft, XAI is really eating Apple's lunch here. Apple really doesn't have an AI strategy. They're relying on ChatGPT's services to be integrated into the iPhone, which, arguably has potential, but the fact that there isn't a real Apple or AI solution themselves, they will always be behind the curve and relying on third parties for their technology for AI really leaves a lot to be desired with regards to the use of AI on iPhones. So for those reasons, I think Apple currently represents one of the largest downside risks in the US equity markets from a valuation perspective. Trading at 33 times forward earnings. I think there's some continued downside exposure in Apple that I'm seeking myself, and I think is worth paying attention to as an investor. With that covers what I wanted to share with you here today. Like I said, the overall tone in the market has substantially shifted here now that we've broken below all of the major support levels that we spoke about here last week on the US equity markets. But if you look at the overall sector rotation, things don't look terrible under the hood. We're not seeing kind of that panic selling across all 11 sectors. The fact that we have the more defensive sectors continuing to trade higher and outperform the S&P 500 in itself is a good sign. And at the moment still represents what is likely going to be a buying opportunity over the next few trading sessions, unless things significantly deteriorate from where we are right now, which is certainly possible. But that's why I'm here every Tuesday to help update you and make sure that you stay on top of what is happening here in the markets, both from a broad macro perspective, but also individually looking for trade ideas for the week. With that, thank you so much. I hope you guys have a great trading week, and I'll see you guys here next week.